So the Rent Guidelines Board just met on May 7th and they voted to potentially freeze the rents. But the truth is that if you're a building owner out there and the decision of whether or not to freeze rents is going to make or break your business, well, that's just a symptom of a much deeper issue. This is Roman Sinclair. I am the owner of Sinclair Realty Group, a middle market investment sales platform focused on the New York City market and selling buildings from $1 to $20 million that often get overlooked by more institutional brokerage houses for owners that typically don't have access to white glove brokerage services. We also publish the Roman Sinclair New York Multifamily Newsletter. This is something you may be familiar with if you're watching this video, where I distill a lot of the news events into things to look out for, things to get excited about, things in between. And I also apply a lot of context to truly understand what the headlines are and are not saying. So please join us on the newsletter if you're not already part of it. It's a great way to get smart on how to invest in New York multifamily real estate, some of the value traps to look out for, some of the way things work, property tax policy, zoning rules, rent stabilization policy, things of that sort. So today I want to take a beat and look at the Rent Guidelines Board story. So we're in May, we're in the middle of May now. This will come out May 18th on Monday. So at this point in time, New York City tends to focus a lot on the Rent Guidelines Board and the decisions that they are making. So to that extent, the Rent Guidelines Board right now is going to be weighing what its final decision is going to be on June 25th, 2026. And so from now until then, ownership groups, lobbyists, as well as tenant advocacy groups, tenants, elected polls, all these folks will be sort of having their conferences, having these discussions right now to figure out uh, how that vote is going to land. And this is going to be what the New York Times covers and all these publications, right? So we're going to hear a lot about this in the next few weeks, as we do every year. We're in the cycle. So I just want to start the video off by echoing my comment earlier. I think ultimately the city is in a place that is generally dysfunctional if property owners have to cling on to small rent guidelines board increases for their rents to stay solvent. That's a dubious place to be in the modern sort of multifamily property ownership. If we look back like 40 years ago, yes, Rent Guidelines Board offered more generous increases, closer to 10%. But if we look at the 10-year historical for Rent Guidelines Board data, 2026 to 2016 or 2024 to 2014, I've done the numbers actually, and the average rent growth that the RGB allowed is much more nominal, much more like in the 3 to 4.5% range for 1 year leases. So to have to rely on an allowable 3 to 4%, 4.5% rent increase annually um, is dangerous, right? If a large swath of property owners out there are dependent and hinging their solvency on this, it's a dangerous place to be. So what I think that speaks to is if a system that is a little bit dysfunctional, that uh, that is making it seem like this issue is this hot, big, huge issue, but really it's not, right? Really, there are a litany of other things that should be looked at to speak for the health of the New York City multifamily market, both as an investment category and a housing and a heuristic for sort of housing the people of New York. So those are my thoughts. Those are my comments. It's very, very important I get those out. I don't think the RGB vote is the be all end all. I think to label it that way is misguided. Um, that being said, this is the month where it will be getting all the attention that it usually gets every year. The question to consider then is, does the RGB does the RGB have the evidence and the data necessary to pass a rent freeze? As everybody knows, the rent freeze was a huge part of Mayor Mamdani's agenda when he ran on his platform. It was even its own section on his website. I have previously stated that I do not think he will accomplish a rent freeze. And it's something to pay attention to. And the Rent Guidelines Board, RGB board, is meant to sort of look through the data and make decisions for the benefit of all renters and building owners of New York City. The board is composed of representatives that support landlord interests. The board is composed of tenant advocates, and it is composed of neutral parties as well as the board chair. Mamdani appointed 6 out of the 9 RGB board members, and so the common thinking is because he had the appointment over so many, 6 out of 9, that gives Mamdani's spirit, his political leanings, it gives him preference in the way the board will lean with its vote. This is sort of the common thinking in the circle. But the actual mechanism that the RGB is supposed to use for making decisions is to review the data around building profitability, operating expenses, and inflationary data to understand what increases allow property owners to keep running their buildings and tenants to keep staying in their homes and being being happy with their properties with their units. So market context I think is important. As I mentioned, the preliminary vote just happened on May 7. So let's do this. So the key question today is going to be whether the data supports that rent freeze, right? That's what I want to focus on. And as part of that, I want to first give some quick context. We've done a lot of that, but we'll do a little more quick context. Then we'll actually dig into what the data is saying. And then number 3, I want to talk about some issues with the methodology that don't really get much attention these days. There are some glaring problems with the way that the RGB actually, the methodology for the data it uses. So those will be the 3 things we focus on. Then we'll kind of wrap it up with some quick things to look for in these next coming weeks. As building owners continue to operate their properties, and as investors may want to consider what the events in New York City mean for future investment in New York. Okay, so market context, looking into the data real deep, and then some problems with methodology. So context is like this is all going on in New York City, but New York City real estate exists, of course, within the U.S. real estate system, which is governed by and large by interest rates, which are going to price the debt responsible for like 70 to 80% of the purchase prices on these assets, right? So when so much of the money coming to purchase these assets is coming from the debt capital markets, things like the 10-year treasury, the 5-year treasury yield, where those yields are, plays a tremendous influence on how many deals get done, what price they get done at, and if those prices are adequate and accepted by the sellers and owners of those properties. So right now we're in a place where interest rates are lower than they were maybe a year ago, but significantly higher still from where they were in 2020, 2021, and the beginnings of 22. So rates are sort of in this higher place. Some loans have reset to higher rates than they were a few years ago. This is a story I hear a lot from property owners. Um, Additional context just around global events. Right now, the U.S. is in a Middle Eastern conflict, I guess, in several fronts. Most recently with the Iran war, this is causing issues with the pricing of energy and oil. Um, I also believe a nation in the Middle East, I think it was the UAE, is leaving OPEC. So there are some disruptions happening in the energy markets. This is certainly going to increase pricing for oil in the global markets, including in the US. As I wrote about in one of my more recent pieces, actually, that I'll be sure to link below, there are something like 40 plus countries in the world that have gone into emergency conditions because the Strait of Hormuz is blocked and because oil prices have increased. Right? There are Bangladesh. Bangladesh has closed its university school system to conserve energy use. That is a huge and really significant step that speaks to the severity of conditions at the international level. So Bangladesh has sounded the alarm. There are 40 plus countries that have created temporary band-aid solutions to reduce energy use through the cutting of services. But Bangladesh has sounded the alarm, and I think one or two other countries have also hit that big red button, which really, I don't think folks in the U.S. really understand what what that actually looks like. So I thought that was important to highlight. Um, in addition to oil prices, right? Oil prices are going to increase. They're going to have an inflationary effect. And I talked about the 10-year Treasury yields. We talked about oil prices. So this is all going to translate to elevated inflation. The CPI for the month of April, the trailing 12 months, came in at 3.8%. This is the highest since since May of 2023, 3 years ago. So this is not something to sort of look at and dismiss. This is a big deal, and the crises in the Middle East could get resolved, and maybe things kind of simmer down. But there's actually reports from chief executives, from policy analysts that suggest the damage that has been done is not going to be fixed overnight. There is sustained damage as far as the oil production capabilities and the supply chain that really relies on a lot of this crude oil and potentially natural gas. So, you know, real estate owners want to watch the 10-year Treasury yield. Real estate owners in New York City, just as across the US. And right now, what's happening to it? The crisis in the Middle East is causing a lot of uncertainty, which is raising the 10-year Treasury yield. And you have inflationary measures like the CPI that are showing signs of elevation, which suggests inflation, which means even if there is a new Fed chair that comes into place, it may not allow them to reduce inflation, to reduce the interest rates on on um, on debt, right? That might not be possible on the overnight rates. So this is something that New York City owners need to make sure is in the back of their mind, right? Like we're talking about the RGB, very important. New York City exists inside of the U.S. The U.S. right now is seeing much higher interest rates than it was 4 or 5 years ago, and based on current conditions, it looks like those higher interest rates are going to persist. In fact, J.P. Morgan report suggests that there will be no rate cuts for the remainder of the year, with the first change in rates coming in Q3 of 2027, which will be a rate hike. So that's just something to think about as multifamily investors and current owners navigate questions and investment decisions in New York City. So that's the context that we're in. Let's see if there's anything else I wanted to hit on that. Um, New York City did solve its budget gap. I guess Mamdani figured out a way to do that. I'll talk more about that in another video. So that's a little bit less of a concern right now. Um, the main things are these national forces playing an important role. So let's actually look. Let's turn to looking into the data. If you look at the data that the RGB is using to guide a lot of its decision making, it's actually coming from an RGB report itself. So every year, the RGB has a report on income and expenses for rent stabilized buildings, because the RGB ultimately is only covering rent stabilized buildings. It's not looking at fair market or exempt properties. And this is called the income and expense study. It comes out every year, usually around the March, April timeframe. If you look at this year's report, it's really eye-opening. It's really interesting. A lot of commentary has been, let's say, concentrated on the headline numbers, on the soundbite pieces, and I don't think they tell the full story. The headline is NOI on multifamily buildings that were rent stabilized that were included in the RGB survey and potentially coming from RPIE taxes, real estate property income and expense, 6.2%, right? So according to the RGB, multifamily buildings saw their NOIs increase 6.2% year over year. Well, they dig into this data a little bit. They break it down, and I took a look at this data and also broke it down the way they had it segmented. So all the buildings across the board in the report are at 6.2% NOI growth. But buildings that are 100% rent stabilized only saw 2.4% NOI growth. And buildings that are rent stabilized 100% and that are built prior to 1974 are seeing NOI growth of only 1.4%. So depending on which group an owner's building falls in, there may be great variances insofar as their NOI growth. Because to get to 1.4% for 100% stabilized properties prior to 1974, to get to 1.4% to the 6.2%, wow, that must mean there are a lot of buildings, right? The 6.2% is an average across groups. So if you're going from 1.4 to 6.2, that means there are a heck of a lot of buildings that are perhaps earning higher than 6.2, right? 10% NOI growth, maybe 12%. So that's huge gap, right? Huge gap. So what's going on there? Well, I think the story can be told largely geographically. So if you think about New York City, and this is included in various data sources, but the New York City Housing and Vacancy Survey of 2023 does a good job of distilling this, segmenting it, and really just laying it out. So the Manhattan has some of the has the lowest concentration of rent stabilized units per building on average in the 5 boroughs, except maybe Staten Island. The Bronx has the highest concentration of rent stabilized units per building across the 5 boroughs. So with just that difference alone, it helps us kind of understand and modulate. So if we look back at the same data that the RGB posted for NOI growth, net operating income growth, and we look at citywide data versus the Bronx data, as I've explained in the newsletter, and as I'll show right here in this chart, if we look just at that, it's a very, very different picture. Across the data set of Bronx buildings in the RGB's data, those properties had negative NOI growth of 0.1%, right? The average was 0.1% NOI growth. Now, if we double click and start to actually look at these buildings, properties that were more than 50% rent stabilized in the Bronx lost lost had negative 1.8% NOI compared to a positive 4% NOI growth for properties citywide. So that's a really, really clear cut picture. You got the Bronx that has the highest density of rent stabilization in New York City. And guess what? Its NOI growth is shrinking. Its NOI growth is negative 5.8% less than New York City's average overall when looking at a population of buildings that are 50% or more rent stabilized. But what's more, we can further segment this data, right? We can look at the data only for buildings that existed prior to 1974. Because most of the issues around solvency and is this building covering its expenses with its current income load, these are not newer properties that benefit from tax abatements that were developed in the last 30 to 40 years. These properties that are struggling to remain solvent are the ones that have large capital improvements that have been delayed and pushed off because the current income from these properties doesn't support making those investments. Those properties are older properties, right? I think it makes sense intuitively. The 100-year-old building is going to have more deferred maintenance. It's going to need more TLC than a brand new one that was put into service 20 years ago. So if we look only at the buildings that are built prior to 1974, right? And if we also filter for just the Bronx buildings, so 1974 and Bronx, and let's say we compare 2026 data from the RGB income and expense study with 2025 data, what do we see? It's a very gloomy picture. In 2025, there was very, very small positive profit, right, in that segment. 1% across all buildings in the Bronx. 0.1% across all buildings in the Bronx built prior to 1974. Across levels of stabilization, right? Variable levels of stabilization, but built prior to 1974. 0.1%. That means 2025 data suggests that all the buildings in the Bronx are barely breaking even. They're breaking even by 0.1%. Well, excuse me, I should take that back. They're not barely breaking even, but sustained over a longer period of time, their NOI is barely outpacing their expense growth. So therefore, buildings like that are on a trajectory to lose profitability, right? Or to be very, very much, very, very close to losing profitability. Anyway, you look at 2026 data for that same prior 1974 Bronx buildings, those buildings now had negative profitability of 0.8%, right? If we look at buildings in the Bronx that were 80% more rent stabilized and built prior to 1974, in 2026, the study says these buildings saw their NOIs shrink by 2.8%. Buildings like these are on a path to become insolvent. Buildings in the Bronx that are 80% or more stabilized pre-1974 are seeing their expenses grow faster than their incomes. So that's not stuff that you can ignore. And if you're investing in multifamily in New York City, if you currently own these buildings, this is real hard data that you should be familiar with. And maybe the policymakers look at it, maybe they don't, but this is the story. When the data is segmented and policymakers look at the properties that are the most rent stabilized and the oldest, they will notice the NOI in many of them is shrinking because the expenses are capped, and the rental increases have fixed caps on them. So the Bronx, I think, really beautifully demonstrates that story with the data. I also wrote a newsletter where I included a chart on this. You could see in the 2025 report, expenses outgrew income growth by 1 whole percent. And in 2026, the case actually worsened, and the cost growth outpaced income by 1.7 percentage points. So income grew, rental income grew by 3.2%. Expense expenses grew by 4.9%. That means expenses grew by more than 50% more than rent increases. So the data tells the story on its own. So that's really important. I think that's what investors who consider entering the space should definitely be aware about, and that's something policymakers hopefully consult as well. And it's something property owners know very, very well and are struggling with today. On the methodology side, I think we're going to take a little bit of a different approach here. Many groups take issue with the fact that the RGB analysis does not look at debt service. It does not consider interest rates in the expenses for these properties. And another concern is that a lot of these properties are considered financially distressed, and they were financially distressed last year, and that status has not changed. So these are some concerns that we see often. What I want to focus on, though, is a little bit different, and I maybe will stun you. But the data we've been looking at this whole time, I've been contrasting different Bronx data sets, looking at the 26 data versus the 25 data. Well, that data is actually from years ago. So the data for the RGB that is included in this year's report is actually coming from real estate property income and expense filings, RPIEs, from the 2024 year. Again, the data informing these 2026 reports is coming from 2 years ago, right? The RPIEs get filed in summer of 2025. The RGB analysts review it closely in the fall, I guess in early winter of fall of 25 and early winter of 26, and that allows the report to be published in early spring, late winter of 26. So all the data that's being considered here, all of the data here is actually 2 years old, and that is and one more thing I want to add about that too, right? So that data is 2 years old. And now let's think about the stuff I've been talking about today. I've been talking about NOI shifts year over year, right? 26 data versus 25 data. What does that mean? That means the 25 data, the data in the RGB 2025 report, is actually from 2023. So to put this all together, the data the RGB is supposed to consider and look at is they're contrasting 2023 and 2024 numbers to make decisions today. There was a different president in the White House at that time. There were a different set of geopolitical conflicts at that time. And New York was a very different place during that time period. So it's kind of startling that the data is so outdated. I mean, things change quickly in 2 years. In my newsletter, I wrote a few funny examples, right? Alexander the Great conquered Greece in 2 years. The Empire State Building was completed in 2 years. The Eiffel Tower was completed in 2 years. AI has grown and significantly evolved from what it looked like just 2 years ago. So to use those numbers is kind of startling. I mean, imagine if the Federal Reserve was basing their rate setting decisions off of unemployment figures from 2024. It just wouldn't fly. So a lot of interesting things to look at here. I want to sort of summarize quickly, right? So first, I think the headline is the system is in trouble if the only thing saving a property owner from significant distress is a 2 to 5% rent increase. That is a problem. That being said, right now is the period of time when RGB will be making its decisions, and it is important to some degree to clue in to how it's making decisions to understand what that means if you're considering investing in a space or if you're an owner that's really relying or hoping for that rent increase. So the data essentially, then we talked about the data, right? The data is essentially saying the rent stabilized buildings are largely treading water or losing money, right? So whether this is a function of the court system and the logjam of cases that are there that lead to some tenants not paying rent or some owners not being able to collect rent from tenants, or whether building conditions not being maintained by owners the right way, right? Forcing folks to live in bad conditions. Maybe that's spurring some issues and rent collections are down. Whatever the case may be, for older rent stabilized buildings that have deferred maintenance, they are losing money. All we have to do to understand this is look at the Bronx. Finally, the methodology for actually making these decisions is deeply problematic because the data is out of date. And if the board's sole mandate is to rely on data and make data-based decision making, to have that's a common refrain we hear. To have that data source be as old as it is, I mean, flies right in the face of the stated agenda that the board is supposed to live and die by. So that's kind of what we covered today. Looking ahead, I think some interesting things that some interesting things to consider as investors, maybe policymakers as well. So right now, the board's still in its preliminary decision-making stage. The final vote will be in June. The vote that happened already is a pretty good signal for what the final vote will be. So investors should stay tuned and actually see what happens in June. Speaking more broadly, it would be interesting to see the board consider segmenting the way it applies its rent increases. There are some properties that have less deferred maintenance, that do not rely so desperately on rent increases to avoid insolvency. Perhaps buildings like those could be receiving fewer rent increases, and buildings that really needed the additional rent growth could have those without having to, could have those, right? So a segmentation of the different categories of rent stabilized assets would actually make a lot of sense for reforming the system and improving it. Also, something of note to consider as 2026 is fully in force, the biggest lender to the rent stabilized buildings in New York City is Flagstar Bank. And Flagstar Bank has its largest debt maturity coming due in 2027. Approximately $2.9 billion of multifamily debt will be coming due at that time. And I believe half of it is exposed to rent stabilization, which is about $1.45 billion of rent stabilized assets, 50% or more. So that'll be something really interesting to look at, because in light of this rent freeze, having debt come due or be repriced and have interest rates increase from where they were 5 years before 2027 or 10 years before 2027 could add to the cocktail of distress that property owners are facing. Finally, If anything, a 0% rent increase on almost half the housing market, if it were to pass by the RGB, will likely serve to reduce turnover in these buildings as tenants benefit from fixed costs in their lives, and that reduced turnover will simply mean vacancy rates come down further in the rent stabilized housing stock, which will mean new market entrants, new folks coming to New York will have to largely focus or increasingly focus their search for apartments on market rate apartments. And that means the demand will surge because some of the supply will be closed off, and that will undoubtedly lead to steeper slopes for rent increases. Right, that rent growth will look like this maybe instead of this. So that's something to look out for as well. Folks buying well-positioned free market assets, are actually buying that's kind of a good investing option today anyway. But buying that today is effectively a hedge in some ways if the rent freeze does go through. So keep these things in mind. If you have further questions, please reach out to me. I'm available to you at 646-817-4784. You can reach out to me also at rs@sinclairrealtyco.com. We can go over what this may mean for your existing portfolio, for your prospective investments, and I can help you walk through some questions you may have. Thanks very much. This is Roman Sinclair. I am bullish on New York City multifamily.